Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we were talking, I want to finish up a little bit on the market thing here. I want to share some thoughts with you, and then we're going to get into talking about some taxes here as well. All right, one of them, Jeremy Grantham. This gentleman, value investor, he's a GMO co-founder, chief strategist. I was listening to an interview he did, and this is one of the some takeaways from that. One of them, we talk about animal spirits, and in a way, if you look at what's going on with the trading that we've seen here with GameStop and these others, when we talk about animal spirits, we're talking about the individual investor and talking about how we as a herd of investors, if you will, how our behavior can in fact affect markets as well. And we're seeing not just those trades and what it's doing to those individual stocks, but you also see this additional volatility, and you wonder what's going on with regard to the overall stock market. Is this playing into that somewhat? All right, the next is whether or not that piece is how big a play it's having in terms of volatility in the market. There's the other parts of it we are seeing. There's a lot of things that have been going on, and basically people borrowing money to invest and leveraging. That's one, when we're talking about animal spirits piece, this is this euphoria that's coming in when now all of a sudden we're saying, uh-oh, we have we have this event that is maybe just indicative of what's going on the market as a whole. We're seeing, in fact, a lot of people borrowing to invest. This is that type of euphoria, that type of overconfidence sets people up not only for losses, but also can we give, I know, right? I usually turn that off. Let me get that off. All right. We usually are going to see with that type of overconfidence a bumping up, and that sometimes will preclude what's going to happen when we're heading into a bear market. As you've heard Warren Buffett's old saying, as far as when other people are fearful, be brave, and the other way around. When other people are overconfident, you might want to pull back a little bit. The key, again, is, as I said, is how you invest in the first place. This is a time to be cautious. If you haven't paid attention to asset allocation, or if you're not sure exactly how to go about that, this is the time, okay, to get some advice, to do a little more research. As I said, you start with stocks and bonds. If you're 100% stocks right now, depending on, there's a lot of factors here. I'm not giving, advice in too general or too broad a brush here, but think in this: if you're at 100% stocks and you're within, say, 5 years of retirement, depending on how soon you're going to need that money to start pulling it out, you don't want to go into the most vulnerable period is the 5 years before retirement and the 5 years into retirement with regard to your portfolio. If you get into a bear market at that point, that could really hurt you if you're going to need that income as soon as you retire. We don't need you to see a 40, 50% drop, for instance, in your portfolio, okay, comparable to what the S&P's done over the last two bear markets, not counting again the spring of last year. That what we see then is it took 5 to 7 years to recover from those two bear markets. So that's where that window comes in. It's real important to understand that, because we could be seeing a potentially epic bubble here. We have, the Fed still, with their policies and low interest rates and the like, what that's doing. We have this thinking maybe that with the Feds on your side, this is one of Jeremy Grantham's comments, maybe stock's going to rise forever, this thinking. It's a cyclical business, okay? You're going to have ups and downs. You need to have defensive strategies where, starting with asset allocation, when the market drops 40 or 50%, you're only going to lose maybe half that. When the market takes 5 to 7 years, you're going to recover in about half that time as well, okay? And then you're going to have a plan where you have strategies in place so that your income is going to be protected during that period. And that's another important, so that you can ride out volatility with certain strategies, which we talk about all the time on the show. If you need some help with this, you're welcome to call my office. Before we go there, let me finish out these thoughts. Valuations, and this is one of them, going beyond reasonable right now. And this is, if you remember back in the 90s, in particular, the late 90s, as NASDAQ was running up. Now, one of the difference between NASDAQ then and NASDAQ now is these companies now actually have revenue. Okay, they actually are making a lot of money, but this valuation in terms of how much the NASDAQ has gone up is a concern when I see that that comparison between the late 90s and now. A bubble is a bubble. It may not be. It's not. I don't think it would be nearly as dramatic as then, as far as the valuations. Again, because these companies do make money, but at the same time, may they be overvalued relative to that? And the answer is, it seems to be the case. COVID brought in unprecedented action. This is the other part on the stimulus. The stimulus money then, and the other stimulus package, the way that that's all pumped money into the system, low interest rates, those two together are another way to give us a kind of a sugar high. When that runs out, you know, the market's being propped up maybe by that and creating this bubble in terms of people keep pumping money in. We have to be prepared for that to go the other direction. Let's see, and there's some, you know, they talk about Japan back in '95. This was another one that we saw that 65 times earning. You know, what you have to watch this burst of euphoria, as we're seeing, according to Jerry Grantham, in other words, leads to a bursting of that bubble, and stocks are maybe going to sell on future flows of dividends. So this is one of those that, excuse me, that's one of the things to look for. He's talking about value. He's a value investor. He's looking at how you can, and the importance of dividends with regard to stock. I'm not 100% on that one. I think you have to have strategies, and we're going to be getting into more about the defensive, not just defensive strategies, which I talk about all the time, but new strategies that are coming about and some other ways to help you protect your money. Let's see, lost strength, this is the big one, lost strength of economy through lost jobs in the U.S. and worldwide. All right, this is that money to support those markets. If you have fewer people working, think of that piece alone. How many people are putting money into their 401k relative to when we had more people working? And if you have more jobs lost, what that might mean. And if that means future jobs, well, that doesn't take care of the here and now, and the here and now is what we want to protect ourselves from, not be thinking too far ahead and getting ahead of ourselves, in particular at this stage when we have the economy still in a pretty vulnerable state. This also means declining productivity. So that's the companies, right, that are how they make their money. So if we have fewer workers, if they have the companies shrinking in a sense, but yet the value's going up, you can see this is not a recipe, it's a recipe for disaster is what it is. So value may not take, and this is where there's some hidden values out there potentially. We're going to, you know, if you'd like some help, again, on your individual situation, I don't want to get into too much on pushing you in a direction. And the reason is, for instance, to say it might be a good time for emerging markets on the value sector. Well, you need to be careful, because that doesn't, you know, someone might go out and just look, emerging markets, click, I'll buy some of that. No, I don't want you to do that. I want you to do the research and make sure that you're getting into something that you're, you know, fully aware of. Or if you need some help with that, you can call my office and we can share with you different some of the better investments, if you will, with regard to that potentially. Let's see. All right, that's enough on the market part. Just one last thing on that. If you need some help, if this is a time when you think, you know what, maybe I need to pay attention, and I hope you are, because I'm concerned that the potential for a bear is greater than it has been, and we've been talking about it, the potential for it, you know, even over the last couple of years. But even more so with what's happened this year and some of the things that are going on right now. So again, if you'd like some help, call my office. The number is 615-376-5325, and we'll do a comprehensive financial plan, which of course includes an investment analysis where we'll look at your specific portfolio. All right, so that's when I can be more helpful to you, is showing you in your specific situation some of the risks that may be there. We talk in general terms about them here on the show. I talk about, you know, for instance, bonds, watching out for long duration bonds, mortgage-backed securities, high yield bonds, which are junk bonds. This is a time when those could come under stress, and that could add volatility to a portfolio rather than reduce it, which is the purpose that bonds are in your portfolio in the first place. But for bonds to do that, you want to stick with short-term and intermediate-term, investment grade, okay, the highest quality. So short and intermediate-term investment grade bonds would the types of bonds you'd want to have in your portfolio, and then how much would be short-term and intermediate? That would be according to your individual goals and the needed rate of return to accomplish your financial goals. Now, the other piece is on the stock side. and it's important to have a negative correlation with regard to stocks. We talk about that as well. So small companies and large companies, growth companies and value companies. This is another area. Indexing, of course, is very, very important as well, and that's a way to also minimize your costs. So these are things we talk about, and if you need some help with some specifics on your specific portfolio and how it might be improved, call my office at 615-376-5325. We'll send you out a checklist of things to bring to your appointment, including, of course, obviously what you're invested in, so we can do the analysis for you. I'll pull Morningstar reports. I'll go over those with you in great detail to explain, the good and the bad that's in there, and how you can, in fact, based on if it's in your 401k, for instance, based on what you have available, how to improve it. Share with you the model portfolios that I use, that I invest in, and that my clients are invested in. Share that with you. And also there's some new things coming out that we're going to be sharing here in coming weeks with regard to investing, and some new research and some new defensive strategies that we're going to bring on board as well. But if you'd like to get ahead of that, just call my office, 615-376-5325. And not just the investment analysis, but we can go into other areas, talk to you about Social Security, about Medicare, about tax-efficient income in retirement, all that and more. So call the office, 615-376-5325. And when you come in and see me, by the way, I'll also give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. All right, joining me today on the show, we're going to have Dr. Friday with Dr. Friday's tax and financial firm over in Brentwood, Tennessee. Yes, taxes are upon us, so we want to dive into that today and talk about how to prepare. This is that time when soon you'll be getting, if not already, some tax forms in the mail. So, Dr. Friday, what kind of tips might you share just to start as far as getting prepared to get those taxes done?
Right. Well, one of the biggest questions that people are like, because every time we do a tax return, one of the things we ask is, did you get your stimulus money? And people are concerned that that makes the stimulus taxable, and it is not. The reason for doing it is just to be accountable for the money. In many cases, people may not have gotten both of them. Some have received all of it. Some have not received any of it. And on 2020, you can get that refunded to you through your tax preparation. So if you haven't received your stimulus yet, now's the time. If you haven't filed taxes, even if you're not required to file taxes, file a 2020 tax return, and you will be able to obtain your stimulus money that you may not have gotten in the past.
Excellent. Okay, we're going to take a break. When we come back, we're going to dive into the tax thing. That'll be the rest of the show. We'll deal in that. Of course, if you'd like to call and talk, if you've got some concerns, you're welcome to do that, and we'll share as much as we can today. But taxes are going to be the big thing. All right. We want to make sure you keep more of that money in your pocket this year. All right. First, a break though. Join us here. We'll be right back on the Retirement Report.